E. Identify the role of inventory levels and other factors in preparing a production budget. Inventory levels stabilize operations and meet demand. Desired ending inventory provides a buffer against demand fluctuations and supply disruptions. Companies must determine appropriate safety stock policies based on service levels, lead times, and cost considerations. Beginning inventory reduces required production. Existing stock can satisfy part of expected sales, lowering production requirements for the period. Accurate inventory records are essential to prevent overproduction or shortages. Other operational factors influence production planning. Capacity constraints, labor availability, maintenance schedules, supplier reliability, and seasonality affect feasible output levels. Management must balance cost efficiency with customer service objectives when determining production targets. F. Prepare a production budget. The production budget calculates required output. The formula is budgeted sales plus desired ending inventory minus beginning inventory equals required production. This computation ensures alignment between demand forecasts and manufacturing plans. Time-phased planning is essential. Production budgets are typically prepared monthly or quarterly to coordinate purchasing, labor scheduling, and overhead allocation. Detailed schedules support operational control and performance evaluation. Integration with other budgets ensures financial consistency. Production quantities influence direct materials, direct labor, and overhead budgets, which ultimately affect cost of goods sold and profitability. Accurate preparation supports efficient resource allocation and overall profit planning objectives. G. Relationship among direct materials, direct labor, and the production budget. The production budget determines input requirements. Once required production units are calculated, they drive the quantities of direct materials and direct labor needed. The production budget is therefore the starting point for preparing both the direct materials and direct labor budgets, ensuring operational alignment with sales expectations and inventory policies. Input budgets convert output targets into resource plans. The direct materials budget estimates material quantities and costs required for planned production, while the direct labor budget estimates labor hours and wage costs. Both depend on standard usage rates per unit of output. Coordination ensures feasibility and cost control. If material supply or labor capacity constraints exist, production goals may require revision. Integration among these budgets promotes efficient scheduling, cost management, and realistic operational planning. H. Impact of inventory levels and procurement policies on the direct materials budget. Inventory policies influence purchase quantities. Desired ending raw materials inventory ensures sufficient supply for future production and protects against stockouts. Required purchases equal materials needed for production plus desired ending inventory minus beginning inventory. Procurement policies affect cost and timing. Bulk purchasing, supplier contracts, lead times, and just-in-time (JIT) systems directly influence purchase volume, carrying costs, and cash outflows. These policies determine how aggressively inventory levels are maintained. Strategic trade-offs must be evaluated. Higher inventory levels reduce stockout risk but increase holding costs. Procurement efficiency and supplier reliability significantly impact the accuracy and effectiveness of the direct materials budget.